down now by 6.5%. Also reporting earnings last night, trucking firm Knight-Swift Transportation. It's warning of a rapid slowdown in the freight market, and Knight-Swift down now by 5.8%. Briefly on the railroads, among the names reporting after the close of trading today, CSX, its shares down now by 3.2%. Recapping, S&P down 32 points now, a drop there of 0.9%. The 10-year, 4.20%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, great update there from Charlie Pellet. Well, inflation and rising labor costs will increase U.S. national health care spending by $370 billion in the next 5 years. This is according to a McKinsey report. Consumer prices are rising faster than health care inflation, but general inflation has recently driven up health care supply input costs. So with thoughts on that and more, with us as he is every week, Dr. Ian Lustbader, clinical professor of medicine at NYU Langone, back with us on the phone in New York City. Ian, we love having you here. Great to have you here on this Thursday with Mike Regan and myself. How are you?
Always a pleasure. Thanks, guys. Hope everyone is staying healthy and well with new COVID variants out there, but it seems to be under control. But what's not under control, unfortunately, is healthcare inflation. We're seeing rises of over 6% a year. Healthcare is 20% of the GDP, over $4 trillion a year, and really estimated by 2030 to be up to $6.8 trillion a year. And there are a lot of reasons, unfortunately, why we're seeing healthcare inflation, and we can talk about that. But certainly part of the problem is our per capita costs. You know, it's about $12,000 per person per year. Other countries like France, Canada, about half that, $5,000 to $6,000 a year. So the real question is, why are our costs higher than other countries?
Yeah, well, Doctor, I would like to unpack a little bit some of the main drivers of that inflation. You know, my guess would be that there were so many health insurance claims for COVID, whether it be testing or treatment. Is that one of the big drivers of the increase in particularly health insurance costs?
Yeah, there are really a number of drivers. One is hospital care, which is very expensive. You know, you can just look at the bills from even an ER visit. That's about 30% of the cost. The workforce is about 40% of the healthcare costs. And we're really seeing wage pressure, you know, both physicians and RNs, because there's a labor shortage. A number of physicians have retired. A number of nurses are leaving the workforce. So there's really wage pressure in that area. And definitely illness, things like the pandemic, and aging population, and unhealthy population. About 40% of the U.S. is obese, overweight. They use a lot of resources, diabetes, hypertension. More technology also. You know, we have robotic surgery, and all of those are very, very expensive. They're high quality, high tech, but also very expensive. So we're really seeing a combination of things, and the pandemic did not help with resource utilization. All of those nasal swabs that people are doing, sometimes on a daily or weekly basis, really add up, and that's, you know, government money that's been printed in order to give out those kits. So we've really had a number of forces that are raising prices, and there are not a lot of market forces, competition, advertising prices to help lower that. That's part of the challenge.
So not a new, right, we talk about this for a long time, the costs of healthcare. But Ian, I do feel like there's expectations among Americans that I want a certain level of care when I walk in a hospital. I want X, Y, Z. I mean, how do we change the thinking, or how do we really constructively get the price of healthcare down?
You know, you're exactly right, Carol. We want Cadillac care, and we do have amazing high-tech care, really the state of the art, but we don't really want to pay for it. And unfortunately, we will have to choose. In other countries, there are delays if you need elective hip surgery, knee replacement. You can't walk in if you're 85 years old and get it the next week. In the U.S., we can. So I think we need to shift expectations and really say, without rationing care per se, can we change our expectations? We certainly want high-quality care, but if we give high-quality care to everybody all the time without any competition or cost market forces, we're going to be in trouble with a higher percent of our budget.
All right, 30 seconds left. I got to ask you, because I want to know. I'm double boosted. I'm double vaxxed. I've seen the lines for the vaccine. Who should get that next booster? Just quickly. And when?
Certainly,
yeah.
Yeah, the bivalent, which is the B4 and 5, is important to get. Certainly, if you have chronic medical issues or if you're older, above 65, it makes sense. It is available for everyone, young and old, but certainly the target audience should be people with underlying medical problems. There are a couple of new variants out there, too, which may be a bigger problem.
Yeah.
We don't really know how effective the new vaccine is for those, but probably will help. Certainly, if you have medical issues, it makes sense to get it.
How long do you wait after you've had COVID? Yes, I'm asking you, Dr. Les Bader, for me, just quickly.
Your antibodies and T cells are good for at least 3 to 4 months, so I would not rush to get the vaccine if you had COVID within the last few months. There's really no data on that. Your antibodies should be fine for at least 3 months.
Thank you so much. As always, and smart to talk about inflation in healthcare because it's certainly something that's very persistent. Dr. Ian Lusbader over at NYU Langone Medical Center, off to World of National News, and Nancy Lyons. Hey, Nance.
Thanks, Carol. President Biden is in Pennsylvania promoting the bipartisan infrastructure law that has helped repair a Pittsburgh bridge that collapsed earlier this year.
Pittsburgh's a city of bridges, but too many of them are in poor condition, like this bridge behind me before it collapsed. With the bipartisan infrastructure law, we're doing something about it. This is just one of 2,400 bridges across the country that are being repaired just this year because of this law.
From Pittsburgh, Biden is traveling to Philadelphia to stump for John Fetterman, who is in a tight Senate race with Dr. Mehmet Oz. Florida is still working on recovering from the damage from Hurricane Ian. And today, Governor Ron DeSantis announced that a special session of the Florida legislature will be held to consider providing property tax relief for people and businesses whose property was destroyed. He's also extending the deadline for those residents to pay their property taxes. More political upheaval in the UK today, with British Prime Minister Liz Truss resigning 45 days after taking office. She served a tumultuous term in which her policies triggered turmoil in financial markets and a rebellion in her party. Sir Jake Berry is chairman of the Conservative Party and outlines next steps.
In conjunction with the 1922 committee, we have decided that if the party should decide to put forward 2 candidates, there will be an expedited, binding online vote of Conservative Party members to choose its next leader. All stages of the leadership election will be concluded by no later than Friday, the 28th of October.
That's Sir Jake Berry. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Nancy Lyons.
Thank you so much, Nancy Lyons, in our 99.1 newsroom in the nation's capital, Washington, D.C. Carol Masser, along with Mike Regan. He's in for Tim Stanovic here on Bloomberg Business Week on this Thursday. Tim is on assignment. So we've got a great guest coming up in just a moment. Great check on the retail, on supply chains. We're going to check in once again with Joe Preston, President and CEO at New Balance. In the meantime, just thinking about prep for that, a story came to our attention, Mike, and it has to do with Adidas, however you'd like to say it. If you're Matt Miller, you say Adidas.
Adidas. I still say Adidas. I don't know.
I do too.
Do you say Nike or Nike? Remember?
Are you kidding? Is that a thing?
Well, which one? What's the right?
I say Nike.
Yeah,
I say
think
Nike.
that's correct.
I do
Right.
say Porsche too, rather than Porsche. All right. Adidas warning that unsold goods are piling up as consumer demand is weakening across China and Western markets, prompting a fresh profit warning from the sneaker maker. This certainly caught our attention.
Yeah, absolutely. And actually, the latest in some troubling news for Adidas. Remember, they are on cold ice with Mr. Kanye West when his sneaker brand called Yeezy put that under review amid growing acrimony and erratic behavior from the hip-hop icon and designer. I wonder if any of Kanye's shoes are among the unsold sneakers piling up. I doubt it. I think they sell pretty quick.
I was going to say, and they're pretty expensive, right?
Right.
And, it's, these brands, these kind of iconic brands or brands that have been around, they often partner up with a designer or a celebrity, and it often is a great driver of revenue for the company.
You're right, right. But it really seems like their problems they're running into now are centered in Greater China, just a slowdown there, given, weak currency and still all those COVID lockdowns. I guess people just aren't wearing out their sneakers like they once did.
Yeah, I feel like all those macro issues, right? Whether it's COVID over in China, just the global inflationary picture, we are seeing that certainly impact as companies are reporting their earnings. Adidas now expecting an operating margin of 4% this fiscal year. That's down from a prior forecast of 7%. So that's a pretty big haircut. All right, you are listening and watching Bloomberg Business Week, and this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks are retreating as Fed speak props up hawkish wagers. The Dow, the S&P, NASDAQ, all in the red right now. We've got the S&P down 36. That is a decline right now of 1%. We've got the Dow down 125, a decline there of 0.4%. NASDAQ is down 97, a decline of 0.9%. 10-year yield 4.21%. The 2-year 4.60%. 4.60 on the 2-year. Spot gold, little change, down 50 cents the ounce to $16.28, while West Texas Intermediate crude up 50 cents the barrel to $85.98. After the bell, number of companies will be reporting earnings. The railroad CSX down now by 3.3%. Whirlpool after the bell down 4.1%. Tenet Healthcare Corp down 0.6%. And we cannot ignore Snap Inc. down now by 1.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. Well, stepping away from the turmoil in the UK government for a moment, and yet I got to say what's going on there is just another one of the geopolitical concerns that impact anyone and everyone that runs a company. We talk about it all the time with leaders. So we're curious to see what our next guest has to say about the macro environment. And so great to have back with us Joe Preston, President and CEO at New Balance, privately held, spending some time with our editorial teams here at Bloomberg headquarters. He is here in our interactive broker studio. And it is so nice because I think if it was a year ago or 2 years ago, we would probably be doing something remotely. How are you?
I'm doing well, thank you. It's nice to be here in person.
It's great to have you here. What's it like running a business right now in this macro environment, but coming off, thank God, the worst of the pandemic?
Well, it's a challenge, there's no question, because there are just so many different things that are being thrown at any company out there for the past 2.5 years. And I think for us, the biggest challenge is balancing the momentum that we have, which we're seeing here in the U.S. and around the globe, with those macroeconomic trends, because we don't want to miss the run that we feel like we're on right now. The brand is resonating with a younger consumer like never before. We've just had our strongest back to school in our history.
Wow.
And we can see from who's buying on newbalance.com, the age, the demographics that are coming into the brand for the first time. And then we're in close contact with our customers, our trade partners, and they're telling us the same thing. So with that being said, we also know that with interest rate hikes and the inflationary pressures and all of that, and the supply chain still is, particularly from a logistics standpoint, is still struggling. And so we're trying to balance all of those pieces together.
Yeah, Joe, I wanted to ask you about those supply chains. I think New Balance is somewhat unique in that you have some big factories here in the U.S., in Massachusetts and Maine. Does that make dealing with these supply chain issues easier or harder when you have your actual factories in the U.S.?
Well, I mean, they're challenging throughout the past couple of years. There's no question about it. But yes, we have 5 factories in the U.S. We're the only athletic brand that has a presence here in the U.S. We also have a factory in the U.K. And again, the only athletic brand to have a factory over there. And it's a limited portion of our overall revenue in pairs, but it's an important piece of our business. We think it helps our quality scores, and it just allows us to be a better partner with our contract manufacturers because of the fact that we're making shoes and we know the processes, and then we can pass along those tips to them as well.
Is it more expensive though? Like I always think about, I love talking about anybody who's manufacturing in the United States because we're talking about more companies doing it. Is it more expensive?
Well, the labor is definitely more expensive. The cost of the materials are the cost of the materials. So it really resides in labor. So if you look at it strictly from a P&L standpoint, you could make one decision. But there's also getting closer to the consumer. There's also the fact that you can run your inventories leaner because you're not relying on a supply line that's halfway around the globe.
And have to factor in time to ship it and so on and so forth.
Exactly. And then the cost of capital is rising as well, which makes all of the contract manufacturing a little bit more expensive because you're financing at some point.
You know, Joe, I have to tell you, so I come from Philadelphia, and in 2019, I had my heart absolutely broken by a man named Kawhi Leonard of the Toronto Raptors. He hit what's been known as the shot to knock my Sixers out of the Eastern Coast Finals. If you can't tell, I'm still a little sore about that. But I know New Balance here. New Balance is famous for its running shoes mostly, but you are in the basketball market now with a Kawhi Leonard shoe. I'm guessing it's not selling so great in Philadelphia, I got to say. But how's it doing nationally? And how's the basketball business for you? Is that an area of growth, do you think?
Well, I think, first of all, I guess, what is the expression? I'm sorry, I'm not sorry. So,
Nice.
but yeah, we re-entered basketball. We were the first brand to endorse a NBA player with $1 million contract. It was James Worthy back in the day.
That's right, I remember that.
Yeah. So then a number of things transpired. We got out of the endorsement element of it, and then we got into baseball about 10 years ago. Yeah. And today, about 25% of major league players wear New Balance. And then that led us to getting into global football or soccer. And we have two of the top 5 players in the world, Sadio Mane and Raheem Sterling, wearing our product. And then we got into basketball with Kawhi Leonard being the brand ambassador.
Every time I hear his name, I
Sorry.
It's been really good. Yes.
I mean, that moves the needle. Those collaborations are having the professional sports aspect of it.
There's no question. You know, younger athletes are looking to what is being worn at the major league level, whether it's baseball or football or basketball. And so I definitely think that's helped us.
I just want to say, just to follow, I mean, I have a teenage daughter in college now, but I mean, sneakers are like a consumer staple for her, and numerous kinds, like that's her footwear. And you talked about the growth in the younger audience. Is it those collaborations with athletes, or what is it that you think is all of a sudden getting a younger generation, which you know can switch in a dime in terms of their preferences? Why do you think they're attracted to the New Balance brand?
Well, I think it's the brand. Okay. I think the brand efforts that our marketing team has been doing have just been excellent. But you can't just market, you have to have product. Right. So we have multiple new products that we've been introducing that have been resonating. We have been using collaborations with athletes and entertainers that have provided energy. There's no question about that. That combination, as well as the other things that we've done to attract the consumer and then make it a more seamless consumer experience when they come onto our website or come through our stores, we also know that is part of why we are successful today.
You know, Joe, obviously here at Bloomberg, we are laser focused on Wall Street, and obviously New Balance is a private company. But I have to wonder how often some banker shows up at your doorstep, you know, with a flashy suit and New Balance sneakers on and tries to get you to go public or has an M&A offer for you. Is that a common experience for you? And what do you tell them when they show up?
Well, over time, it's obviously been pretty common. But,
yeah.
You know, the company's owned by the Davis family, and it's, you know, Jim bought the company in 1972. It was initially founded in 1906. It's had 3 owners since then. And Jim and Ann just celebrated 50 years with the company, and that absolutely no plans.
Yeah.
Well, as someone who works, the two of us working at a privately held company, you understand kind of the perks and the positives of being privately held. What does that allow you guys to do? And we've just got about 40 seconds left.
Well, it allows you to take a longer view, and I think domestic manufacturing is a perfect example. We've seen public companies in our space come in, make statements that they're going to make product here, and 3 quarters later they're trying to explain it to an analyst, and suddenly it quietly goes away. When you're private, you can take a longer view.
One last question, 30 seconds. If you had to describe the environment for the next 6 to 12 months, what's 1 or 2 words that you would use to describe it, or 3 words?
Uncertain. I think that is definitely one that you have to keep in mind. And for us, it's balance. It's about balancing the momentum that we have with the macroeconomic headwinds that are out there.
You're using that because your brand is New Balance. Is that what's going on here? Is that a little
nice
marketing?
Plug. Well done.
What a pleasure. And so nice to have you in studio. Be well, and we look forward to you coming back real soon. Joe Preston, he's President and Chief Executive Officer of New Balance, joining us here in our Interactive Brokers studio. Coming up in just a few minutes, we join our TV colleagues for a look at the market. Stocks hovering near their lows of the session on a spike in yields once again. Carol Master, Mike Regan, and this is Bloomberg Business Week on Bloomberg Radio.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
Oh, this is Countdown to the close. We are but 60 minutes left in our trading session. Caroline Hyde, Taylor Riggs, joined by our colleagues Carol Massa, Mike Regan, in for Tim Stenovic. We together welcome across our audiences of TV, radio, YouTube, a day where we see once again volatility, and we're off the lows. We're still underwater by 0.7% on the S&P, Carol.
Yeah, real slog for equities. As you said, though, Caroline, coming off our worst levels of the session. Some outperformance, though, we are seeing once again in the semiconductors area. We've got the stocks up about 0.75%, was up almost 4% earlier in the session, but off those highs. The real reason why, though, Lam Research, first quarter beat and a reset on expectations. A lot of analysts weighing in saying that forecast as a necessary resetting of expectations for the semi industry, because we know there has been so much negative news out there. Lam Research right now, Mike, is up more than 7%.
Right, Carol. And speaking of negative news, obviously another down day on the market. If that seems familiar, it should. Actually, it's a stat courtesy of LPL Financial. There's only been up days 43.5% of the days this year. That is actually the lowest percentage since 1974. The good news, though, is that in the following year, the market tends to rebound typically, usually somewhere in the range of 15 to 17%.
I mean, it feels like those 43% of days are swiftly followed by an up day. I mean, and we never seem to have any consistent days of trade at the moment. And at the moment, we are off by 0.7%. Having been higher in the earlier in the trading session, we're now off by 26 points on the S&P 500. We're off by 68 points if you're looking at the Dow. The Nasdaq is off by 63 points. That's 0.6% lower. Volume's just up ever so slightly, about 6% on the day for the Dow, for the Nasdaq, I mean. And the Russell 2000, once again, in the eye of the storm, it's underperforming, off by 1.2%, Taylor.
We are marginally seeing some improvement on a sector levels. We are now within 1 hour to that closing bell. Instead of communication services being the only sector in the green, there's a few others. Energy and technology, of course, as we keep our eyes on some of the big quarterly results. Snap, of course, we'll get today, and some of the bigger guys next week as well. On an individual basis, though, I really sort of went negative here. I wanted to start with the airlines. Carol, I thought of you when I did this. You got some decent results from American and Alaska, but a little bit of a rollover here when you think about some of the profitability and how we're thinking about these individual numbers. Allstate came out with some...
Can I just say, too, that group has had such a run, Taylor. You know this. You follow those trend lines. I mean, they were up for like 6 days in a row. So, yeah, you can see why there might be some disappointment.
Yeah, a little bit of a breather there. Allstate's also thinking about disappointments, Carol, when you think about they pre-announced and really looking at an expected adjusted net loss now of about $400 to $450 million. And quickly, of course, Ally Financial, you're only off, Caroline, 0.5%. But we were talking earlier, if this is a company that's starting to see cracks within the auto market, you now have autos and housing under pressure, and these higher rates are impacting some of these sectors now.
That's really smart to point out. What's also been a volatile day of trade for equities ain't nothing when you're looking at volatility in the FX space. And I bring this chart for a radio audience. I'm just going to explain it because the pound volatility has been rising. It's the white line at the bottom, has been creeping higher. We talk again, once again, of UK instability, of a changing of the guard in prime ministers, the shortest tenured prime minister ever. And then we actually see it basically in line with crypto volatility. Bitcoin volatility has been falling, but now down to the heady heights of basically where the FX volatility is at for the pound at the moment, Carol.
I love that chart, right? The volatility. And I was thinking about, Caroline and Taylor, how much, is facing investors at this point. So much to take in. And Sonali Basak caught up with John Gray, who's Blackstone Group president and CEO earlier. They own a portfolio of companies, so they get to see a lot of things about what's going on. And I think bottom line, it's just more nervousness among those who are running some of their portfolio companies. Here's what he had to say.
If you talk to our companies, they are becoming more cautious. Their CapEx plans are being lowered. Their hiring plans are slowing. And so we see this happening with a lag. I was talking this week with a developer of apartments who's building this year 15,000 units across the U.S., major developer. And he said next year he's cut his plans by 75%.
Yeah, so interesting to see nervousness among some of the heads of their portfolio companies. Of course, John Gray, Blackstone Group president and CEO. He did say, though, he thought that maybe we're getting close to inflation peaking. At least we'll see what happens.
He spoke pretty eloquently as well, Carol, about the UK, saying about the great attributes that the UK does indeed have, and the law of transparency, the liquidity. Another great attribute the UK has is one Guy Johnson, who stands by waiting to talk to us about what is, of course, a top story in Game of Play today. The UK Prime Minister Minister Liz Truss resigning from office. Just talk to us, Guy Johnson, staying late once again, host of Bloomberg Markets at the close over in Europe. What are you making of this narrative, the way in which we now look to a new leader? Does the pound fading mean anything for you, do you think?
Not really. I think what is interesting here, Caroline, is that we've seen over the last couple of days, since the appointments of Jeremy Hunt, a separation of the kind of the political pantomime that is taking place in Westminster and what is happening in the City of London and what is happening with the financial markets. So there's been a certain level of stability that has been reached. I think the markets are watching what is happening cautiously. They're at the moment prepared not really to react very much to it. In theory, we might have a new Prime Minister by next Monday. At the latest, we will have a new Prime Minister by next Friday. I think the arrival of Boris Johnson on the scene has shaken things up a little bit, but nevertheless, the growing expectation is that it will be either Rishi Sunak, who is probably going to be greeted fairly well by the City of London, or Penny Mordaunt, who is the leader of the House, be one of those two candidates going forward here. But the critical thing is that Jeremy Hunt will likely stay as Chancellor, and as a result of which the City of London, the financial markets, are taking maybe a slightly more relaxed approach here.
So, Guy, once, we'll eventually know who takes over as Prime Minister, but as a result, whoever gets into that spot, they are inheriting a grim UK economy. I mean, there's a lot facing them right out of the gate.
Absolutely, Carol. Look, the UK economy is slowing down fairly rapidly here, and we've also got super high inflation. We've got an inflation read this week. It is at 10%. The UK consumer is being squeezed from a number of different angles. You've got the energy story on the one hand. You've got rising mortgage rates on the other. You've got a slowing economy that is putting pressure on everything. So, yeah, it's a really tough mandate that the next Prime Minister is going to inherit, and they are definitely going to have to hit the ground running. They are going to need, basically, to not put a step wrong. They need to continue to keep the financial markets on side. We've seen what happens when the financial markets are not on side, and I think everybody in the UK has learned that lesson very, very quickly. So it's going to be a really tough challenge, a really difficult story to navigate going forward for whoever does become that next Prime Minister.
Yeah, investors not bashful about saying how they feel, that's for sure. Guy Johnson, thank you so much. Long day for you and some great coverage in terms of the political instability, if you will, and nervousness in the financial markets. Our Guy Johnson there over in London. All right, that's a wrap. We're going to be back on radio and TV and YouTube, our cross-platform coverage Beyond the Bell. We're going to count you down to the close on this very busy Thursday. We'll be back at 4 p.m. Wall Street time.
You're listening to Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, yes, indeed. We're going to rejoin our TV colleagues in less than an hour's time to wrap up that Thursday trade. In the meantime, Carol Massar, along with Mike Regan, Tim Stenovic is on assignment on this Thursday. And we do have equity markets. Mike, once again, it's a trade we've seen. We've seen strength. We've seen a pullback. We've seen rounding, off the bottom. And here we are with, about 40 minutes to go here.
Yeah, what is the old expression? If you don't like the weather in Chicago, stick around. It'll change. I think.
Well, and I do wonder, you've watched a lot of market cycles. Like, to me, and I've seen a lot of market cycles, I'm not about to call a bottom at this point, but I do feel like when you have incredible swings and reactions in the market, it does feel like investors are trying to, such out where the low is.
Yeah. And you know what? It's just been such a strange year. There's very little you can go back to in history as a comparison and use as sort of your playbook. It's just...
You don't remember coming out of a pandemic before?
with 8% inflation?
No.
And a major war going in Russia? Not in my lifetime. I'm old. I'm not that old.
No, exactly. And there was some great stuff. I keep repeating this on Surveillance yesterday morning about just this whole idea of that what will be kind of the real rate when it comes to the Fed going forward. Can we really think 2% is it, or is it more like a 4 to 5%? And a guest on Surveillance is talking about these massive changes we are doing and the impact of climate change, pushback on, globalization, and also demographics and aging population. Yeah. These things have costs.
That deglobalization, I think, is a very underappreciated element of all this, for sure.
Right. It really changes things. All right. We're going to continue the conversation, Mike and myself. Right now, though, we're going to hand it over to Nancy Lyons. She's in D.C. with World and National News. Hey, Nance.
Thanks, Carol. The political landscape, as you've been discussing, is changing once again in Britain. Liz Truss is stepping down as British Prime Minister after her government collapsed in the wake of a budget plan that included unfunded tax cuts. Bloomberg's David Merritt says her departure is not a surprise.
It's been clear to most observers, actually, for some time since that economic blow-up of her first budget, her big attempt to remake the British economy a couple of weeks ago now, that her position was going to become untenable. She sacked the Chancellor and blamed him, Kwasi Kwarteng, but the markets lost confidence in her vision.
Again, Bloomberg's David Merritt. Sir Graham Brady is the chair of the committee determining next steps. He says a new leader will be selected next week.
It will be possible to conduct a ballot and conclude a leadership election by Friday, the 28th of October.
Brady says nominations will close on Monday. Ukrainians are being warned of rolling blackouts because of damage to the country's power grid from Russian missile attacks. President Volodymyr Zelensky is urging residents to conserve energy when possible. The former U.S. ambassador to Ukraine, William Taylor, says Vladimir Putin's bombing campaign is the only thing he's capable of doing right now.
He's losing on the battlefield. The Russian military is being pushed out of the north. The Russian military is losing ground in the south.
Taylor says Putin's atrocities make him unsuitable for any kind of ceasefire conversations with the Ukrainians. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Carol Master along with Mike Regan here in our Interactive Broker studio, streaming on YouTube. So I hate doing taxes. I'm just going to put it out there. Even though I get an assist, it's like just the prep work. But
my wife fired me as our tax accountant after too many errors.
You're done?
Yeah, even with TurboTax,
Does she do it then?
No, we hire a guy.
Yeah. But even like all the prep that you have to do, it's just...
Yeah, all the documents. And when you have two states going on, you know, I live in New Jersey, work in New York, it gets complicated.
Right, the crisscross. All right, so the IRS, we've got a story by our Paulina Cachero on the Bloomberg and at Bloomberg.com. The IRS has raised tax brackets and the standard deduction by about 7% for 2023 as the soaring cost of food, energy, and housing continues to batter Americans. So what does that mean?
I think it's the one positive about inflation that we've heard so far. You know, the IRS, obviously, as the story says, adjusts the tax code annually. And, you know, the goal is to shield
I had no
Americans.
idea that they did that.
Yeah. I don't think it ever usually goes up as dramatically as
Right?
it does because of this inflationary environment we're in. You know, Social Security payments are going up. So
That I get.
you know, I guess if you have to look at a silver lining in this environment, there you go.
All right, so it is apparently the 7% increase, largest increase to the standard deduction since the tax system was first indexed to inflation back in 1985, will reduce the amount of income subject to taxes for most people. And as Mike was saying, the IRS adjusting the tax code annually to shield Americans from paying higher taxes as rising prices erode the value of the dollar. Changes have been, as he said, fairly incremental in the last few years, but that decade's high inflation prompting an unusually big tweak for 2023, according to the folks that our team talked to.
Yeah, and the standard deduction goes up, will rise to $13,850 for single filers and $27,700 for couples filing jointly. So
reason to be happy about paying taxes.
Yeah, but I'll still probably mess up the taxes. Hopefully my accountant's
To Mike's
on top of
wife, I
this.
totally get it. All right. You're listening and watching Bloomberg Business Week on this Thursday. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 43 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ, all in the red. We're on the minus side right now. Let's find out what's happening as we head over to the first word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
And good afternoon, Charlie. As you said, stocks are trading lower amid fears over further rate hikes from central banks. The Dow is down 40 points, S&P lower by 20, with the NASDAQ falling 55 points. The U.S. 10-year yield is at 4.22%, and small caps are down 15. 8 of the 11 main S&P sectors are trading lower, with utilities and industrials providing the biggest drag, while communication services, energy, and tech are trading higher. NASDAQ biotechs fall 20 points, transports sink 260, semis are higher by 1%, while the VIX is down 1.3%. Leaders in the Dow, IBM, Salesforce, and Verizon, while Home Depot, Travelers, and Caterpillar are the worst performers. After earnings, Tesla touched the lowest since June 2021 as revenue missed expectations. AT&T jumped after customer growth topped estimates, while Union Pacific fell the most in 2 years after it cut forecasts. In other news, the Twitter deal spread hit its narrowest level since Elon Musk announced his takeover plans. Wrapping things up, look for earnings from CSX and Snap Inc. after the bell. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey, and to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. I got to say, I was certainly glued to the Bloomberg this morning, listening in on my phone as I was commuting in as we covered the UK Prime Minister Liz Truss quitting. 44 days, that was it, and a very brief and chaotic 44 days it's been. That saw her announce a massive package of tax cuts before unwinding most of it in the face of a market rout. Well, I got to say, he was on with our surveillance team with us earlier today. Great to have him back on air. Former UK monetary policy official Danny Blanchflower, a British-American labor economist, professor of economics at Dartmouth College. Great insight. And if you were following his work and writings, you wouldn't be surprised by what happened earlier today out of the UK. Danny joins us via UK in Hanover, New Hampshire. Danny, how are you?
I'm very good. Good to talk to my friend Carol.
Well, it's...
How are you? What a day. First time on Bloomberg today.
Oh, my God.
First time on at 6 o'clock where we said, I don't think she can last the day. And at 8:20, Bloomberg calls me and goes, Danny, go back to the camp. We're about to get the announcement. Entirely expected, though, Carol. I think entirely expected from the moment they did the mini budget. I think the economics have driven everything, and then the politics collapsed around it. But eminently predictable, disastrous, and obviously it's put the UK in a very, very bad position now. An advanced country that just looks like it's lost the plot.
You know, Danny, as the Conservatives look for a new prime minister, how important is sort of market savvy, economic savvy going to be in that decision? Is that going to be their top priority, do you think, after this fiasco?
Well, I think there's two parts to it. Clearly, the priority is you have to ditch all of that stuff, and you have to sit there and try and calm nerves, but with the understanding that the risk premium on UK assets has risen, and I suspect it's risen, whether it's permanently or not, we'll see. So that's going to be really important. I mean, the second one is that the people are going to be really important in all of this, because we're looking potentially at big spending cuts as people have had big rises in their mortgage costs, big rises in their energy bills. And in the end, I think the people cannot be ignored. If you look back to what happened with Margaret Thatcher, essentially Thatcher was pushed out because the people of...
Oop, a little bit of freezing there on Zoom. We're hoping to get Danny back. We're talking with Danny Blanchflower, professor of economics at Dartmouth College, of course, former UK monetary policy official. But I know my team is working on it, so we'll see if we can get Danny back in just a moment. But, you know, I'm thinking about what Danny's saying in that, you know, the tough environment, we talked about it with our earlier guest as well, in terms of, popularism and, what people need right now. I mean, doing policy in an inflationary environment, slowing economy, this is not easy, Mike.
Right. And, like I was saying before, Carol, there's really no playbook for any policymaker or investor in this environment. So, some people maybe are a little bit more forgiving of Liz Truss's mistakes than Danny. I don't know. But it's certainly quite a mess. And really, with that winter coming in Europe, you really have to start to get concerned about what the costs are going to be to heat homes across Britain and Europe, and what is in store for all those countries in the next few months.
Yeah, Ed Price over at Ergo talking about this earlier. Like, you've got to put this against the backdrop of what's going on in Europe specifically. And so you think about, people saying that they're hoping for a warm winter over in Europe because of concerns about energy access and energy costs in particular. So that is certainly something that we've got. All right, we want to get back to Danny Blanchflower, professor of economics at Dartmouth, and as we said, former UK monetary policy. So glad we got you back. Technology
You
keeps us
dropped
on our... I didn't drop you. I blame the tech universe. All right, so pick it up. So in terms of, what's going on and what we need to know and where we go from here.
Well, so what we saw was a budget that did not make any sense. It was going to have an amount of borrowing that simply looked too big for the markets. It was not costed, and the Chancellor made a set of schoolboy errors. So what you had to see was the Bank of England had to step in on the Monday and rescue UK pension funds that were basically going bust because they had to essentially have a fire sale to get assets. On the Tuesday, the mortgage markets basically couldn't price things. And then the political chaos comes as essentially it was clear that budget didn't have any support at all. So the politics have now got ourselves to a point where once again we see a prime minister resigning. How are they going to decide who's going to be the prime minister? Answer, well, maybe 350 MPs are going to sort of wiggle it around and try and sort it out amongst themselves. But maybe if there's two candidates, then we'll allow the same 81,000 people who voted before for Liz Truss, who was such a disaster. And in the end, you have to say, does this government have a mandate? And the answer has to be no. I mean, think back. Reagan and Thatcher did things. They did, all sorts of stuff. But in the end, whether you agree with it or whether you didn't, they went to the electorate. They won an electoral majority, and that's what democracy's about. So democracy is under threat, and the markets are under threat because of this.
All right, hang on, Danny. We're going to come back. We're going to continue with Danny Blanchflower, professor of economics over at Dartmouth, and as we've said, former UK monetary policy official. We're going to come back with him just a moment right here on Bloomberg Business Week.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week. We're going to get back to Danny Blanchflower in just a moment, continuing talking about the situation in UK and what's needed. Right now, though, back to the markets and Charlie Pellet.
Hey, thank you very much. And here's what's going on. We've got 28 minutes to go ahead of the closing bell. Red on the screen right now with the Dow, the S&P, NASDAQ all declining. Another down day. Treasury yields are climbing amid hawkish remarks from Fed officials. We begin with the 10-year with a yield of 4.22%. The 2-year yield 4.61%. Equities lower across the board with the S&P down 37, down 1%. The Dow down 150, down 0.5%. NASDAQ down 90, a drop there of 0.9%. Spot gold down now by 0.3%, $16.25 the ounce. Bitcoin down 0.8%, 19,043. And West Texas Intermediate crude up 0.5%, 85.98 a barrel. After earnings, Tesla shares down now by 7%. A ton of earnings after the close of trading today. Among some of the names we'll be hearing from, CSX, another railroad, down today by 3.6%. Whirlpool down now by 4.7%. Tenet Healthcare down by 0.3%. Don't want to forget Snap Inc. down now by 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
That's right. Snap coming out with earnings a little bit later on. All right, Charlie, thank you so much. Let's get right back to Danny Blanchflower, former UK monetary policy official. He's a professor of economics at Dartmouth College. Check out his writings if you aren't already, because it really gives you some insight into what's coming. Danny's still with us via Zoom in Hanover, New Hampshire. Hey, so Danny, you wrote over the summer, I'm just looking to make sure I got the date, I think it was back in July, you talked about how Liz was not an economist, and that would be pretty significant. You also, in early September, wrote, the likelihood of a depression on a scale not seen since the 1930s is very high. Act now. You are very sensitive to what's going on with a lot of people in the UK, and I would say globally, in terms of those that are just having trouble getting by, paying their bills, and making a go of it in this environment. Talk to us, if we don't get it right here, what it means for the UK and maybe more, as well globally.
Yeah. I mean, since I've written that, Carol, I have a sense relevant to the United States. I thought that these policies were going to be disastrous. And I thought the bond markets and the stock market and the foreign exchange markets would respond. And at one point, a month or so ago, I said, short the pound. But I think a couple of things I want to say. I think what surprised me was actually the sheer speed of this. And the conclusion I kind of draw from it is perhaps these economies right now, including the US economy, is more fragile than I thought. And I know that the Fed and the Treasury are concerned about that, thinking, well, does this kind of knife edge problem, our market's sitting at a knife edge and can be easily knocked off. I mean, I know Janet Yellen apparently was not happy with quasi-quartering at the IMF meetings. So I think that's the first thing. But again, I think people lose the discussion about where Bloomberg's headquarters are and so on. But the question is, what happens to ordinary people? And what you're seeing in the UK is that ordinary people are struggling like they've never struggled before. They can't pay their energy bills, and there's 1.5 million people, I think it's about 200,000 a month, whose mortgages are coming off fixed rates. So they're going from 3 to 6 in a day. And so the problem, what happens to the real person and to poor people, is something we must not ignore. They are really struggling. And then when the government says we're going to put another 20 billion pounds of public spending cuts, this is about real people. And it's probably going to have to go to the National Health Service and just say it to people so they understand it. There are 6 million people today in Britain waiting for surgery. So we mustn't forget that what happens in Wall Street, what happens in the City of London and Canary Wharf, there's another group out there, which is the people. And I think the problem we have here that the UK has is that sometime pretty soon, the people are going to speak. And I think we have to be mindful of that. And what's happened is that there have been severe consequences to that. And we've seen that the so-called trust premium. And in fact, some commentators have called this the moron premium. I mean, there's something to that. So I think we just have to be mindful that if you do stupid stuff, and I warned in these columns I wrote, I said, markets don't like clueless amateurs doing stupid stuff. And that's what we've seen. So I think we really have to be mindful that the politics and the economics and the well-being of the ordinary person are kind of linked in together, and we have to worry about that in the US. And the issue here is, does the Fed go too far, raise rates too much, and crash the economy? And that's still on the table.
That moron premium. I think that's what the car salesmen say when I come to buy a car.
Is that right? Is that right? They sell you the lemon at the back, right?
but Danny, I'd love to do a hypothetical, and let's pretend I had the power to promote you to head of the Bank of England. Two questions. One, do you take the job, or do you run in the other direction as fast as you can? And let's say you take it. What's your priority right now?
Well, I mean, you know, obviously it's a poison chalice job. I mean, you know, here's the poison chalice. Second prize, you get two of them, right? I think the governor of the Bank of England has not performed well. I think it's actually pretty interesting. You have a committee of 9 people. We've not heard from 8 of them. And what's happened is Truss has absolutely threatened the independence of the bank. And when you have an intervention from the IMF, which says, it criticizes the government because it's doing one thing and it's forcing the Bank of England to work against it, I think it's a very difficult environment. And I was taken by Mark Carney, who basically diplomatically said, you don't want to be here. And I sort of thought to myself, if Carney was there, I don't think it would have been, you know, I'm gonna stay away from the poison chalice. Thank you very much.
Just got 30 seconds here. I think about the investment audience here that are listening. Danny, what do they need to know? And just quickly, if you could.
Volatility is here. I mean, it seems to me that the other thing it says is that there are mistakes. And I think you were just talking about markets moving because of bullish talk from Fed governors based upon guessing. So they're literally in a guessing game. They're saying things where they're hoping, and fingers crossed economics, right, that markets will respond and there will not be a crash. But they have no basis for actually showing that it's not going to happen. So I think you have to be very mindful. What it reminds me of is almost exactly what the same people like Bullard and others were saying in September 2008. You can look back and they were saying exactly the same thing. The US had been in recession for 9 months and we should do all of this stuff. So history rhymes and sometimes repeats. Be careful.
Right. I'm going to start a T-shirt company because I'm going to print up T-shirts with moron premium, poison chalice job, and fingers crossed economics.
Oh no!
I'll give you. You're going to get.
I want the one with the lemon, the car lemon.
You're going to get money off of every T-shirt that's printed. Danny, thank you so much. I know a busy day, and you've been really generous to all of us at Bloomberg as we try to make sense of what's going on over in the UK. Be well. Of course, Danny Blanchflower, professor of economics at Dartmouth, joining us via Zoom from Hanover. All right, back to world and national news. Lots going on, as you know. Nancy Lyons in D.C. all over it. Hey, Nance.
Thanks, Carol. It is the story of the day. Liz Truss now holds the distinction of being the shortest ruling prime minister in British history. She resigned today after her tax cut plan backfired.
Given the situation, I cannot deliver the mandate on which I was elected by the Conservative Party.
Truss has been prime minister for just 45 days. Anger in her party had intensified in the last 24 hours after Truss fired Home Secretary Suella Braverman, and then a parliament vote descended into chaos. President Biden is seeing results of the bipartisan infrastructure bill. Today, he returned to the Fern Hollow Bridge outside Pittsburgh that collapsed back on January 28th when Biden was heading to Pittsburgh to speak. Bloomberg's Irv Chapman reports.
The president said the infrastructure bill is paying for 2,400 such bridge projects in this year alone.
Pennsylvania's been able to repair Fern Hollow Bridge in less than a year. The total project cost $25 million, fully paid for by the federal government. It's a modern bridge of the 21st century with 4 lanes for vehicle traffic, a path for cyclists and pedestrians.
The president cited infrastructure projects nationwide, from water pipes to broadband to roads and railroads. Then he headed to Philadelphia for a fundraiser for Senate candidate John Fetterman. In Washington, Irv Chapman, Bloomberg Radio.
Researchers say gas stoves in California homes are leaking cancer-causing benzene, though they say more study is needed to determine how many homes have leaks. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser, along with Mike Regan, live in our Bloomberg Interactive Broker studio. Check us out on YouTube. We're streaming there right now. Tim Stanovic, my co-host, he will be back on Monday. In the meantime, a story by Tom Maloney and Sri Natarajan, definitely catching attention and being read on the Bloomberg big time. This has to do with former star bankers at Goldman Sachs reuniting and backed by Dell's billions. Gotta love that headline, Mike.
Yeah, that's right. That's right. And they're now combining the firms to lead after exit. Trott's Merchant Bank. BB.
Well, we're talking about Byron Trott and Greg Lemkow, first of all.
Byron Trott and Greg Lemkow. So a really big sort of, I guess, happy reunion among the Goldman alum.
Yeah, they climbed the ranks within Goldman, ascending to the top of its prestigious investment bank. I know we've had Greg definitely on this show and on air. As you said, they're combining the firms that they led after exiting Goldman. So Trott's Merchant Bank, BD&T, is merging with Michael Dell's MSD Partners, which Greg Lemkow joined last year as chief executive officer. It's expected, this transaction, to close early next year and will create a firm overseen by Trott and Lemkow as co-CEOs, according to a statement that was put out. Now, Dell, who has a net worth estimated by the Bloomberg Billionaires Index of more than $43 billion, will be chairman of the advisory board. Fascinating.
Yeah, right. And these guys are not exactly lightweights. These two firms combined, they've invested more than $50 billion since 2010. BDT specializes in advisory services for high net worth families, and MSD, they invest in private firms while also making credit, real estate, and growth equity investments. So a pretty diversified portfolio there.
So the letter that has been made and put out in public, Trott saying those three asset classes are, quote, areas that many of you have told us are important to you. MSD's specialist expertise in technology will also expand both our advisory and investment competencies, which we believe will benefit our core BDT funds. I mean, this is money out there, lots of firms going after it and looking to do deals. Anyway, check out that story at Bloomberg.com.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks are lower across the board, on track to close at session lows. 13 minutes to go ahead of the closing bell, with the S&P now down by 28 points. That is a drop of about 0.8%. The Dow is down 68, a decline there of 0.2%. NASDAQ down 65, a drop there of 0.6%. So the stock market seeing another down day. Treasury yields are climbing amid hawkish remarks from Fed officials. The 10-year now at 4.23%. We've got the 2-year yielding 4.61%. Spot gold down $2.50 the ounce to $16.26, drop there of 0.2%. And West Texas Intermediate crude up 0.5%, $85.98 a barrel. We cannot ignore what is happening with the Dow transports today. Transports down by 2.2%. Speaking of transports, among the names after the close of trading today, we'll be hearing from the railroad CSX, down now by 3%. Also reporting Whirlpool down now by 4.7%. Tenet Health down 0.4%. Snap Inc. down by 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. It is 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. With its ground war in Ukraine faltering, Russia has intensified its use of unmanned drones to attack Ukraine's critical infrastructure and signaled a willingness to conduct similar strikes against the West. Last week, Russian President Vladimir Putin suggested that any critically important object of transport, energy, or utilities infrastructure, regardless of location, could be fair game. In the face of such threats, U.S. and European leaders should ramp up efforts to protect critical infrastructure and make clear that any deliberate acts of sabotage will bring an equally punishing response. Russia's threats against critical infrastructure represent a dangerous escalation. Swift and coordinated action to strengthen the West's defenses is the best response. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg Terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just got about 9.5 minutes left in today's trading session, and we are certainly well off our highs that we saw earlier in the day. In fact, we're just hovering off our lows of the session. So as you heard from Charlie, really the S&P feeling the most on a percentage basis, down about 0.7%, following what's going on in the UK, but also really weighing on the U.S. markets is the continued expectation of a hawkish Fed as Fed officials continue to fight inflation. So let's get to it with Eddie Perkin, Chief Investment Officer for Equity over at Eaton Vance Management. He is with us on the phone from Boston. Eddie, nice to have you here with Mike Regan and myself. First of all, the story of the day, or at least one of the geopolitical stories of the day, UK turmoil. How is that, if at all, factoring into your investment outlook?
I don't think it really is. I suppose you could argue that the UK is a canary in the coal mine with respect to the bond market vigilantes and what happened in the gilt market a couple weeks ago. I guess a few weeks ago now, where this austerity package, non-austerity package, led to a bond market sell-off. At least that's the narrative. I think there was a lot more to it than that. I think the UK's relatively isolated from
what's going on elsewhere in the world. It certainly makes for interesting headlines, interesting stories, something we talk about and chat about with our team in London, but not something that's impacting investment decisions on a day-to-day basis.
You know, Eddie, I think the big question this year that just lingers throughout the year is how do you play defense in this market? You know, your traditional defensive sectors are pretty, richly valued at the moment. What's looking like a good defensive play in the equity market to you, given this stubbornly high inflation and interest rates that just do not appear to be going lower anytime soon?
I'm going to challenge the premise of the question a little bit. I'm not sure that I want to play defense right now. You've already had a big market sell-off. As you say, most of the defensive sectors are expensive, so I think you want to avoid the expensive defensives. Utilities would fit the bill there. We're seeing a lot of inflows, ETF inflows into the utility sector. Valuations look fairly rich to us. That's not where I would be hiding. If you really need to be defensive, I think healthcare is probably your best bet. You get good, solid growth and good defensiveness, good dividend yields out of pharmaceutical companies. You don't have to pay a lot for them. So that's the one defensive sector I like. But otherwise, incrementally at the margin, I'd be looking to play more offense by buying things that are beaten up, both cyclical stocks in the U.S. and some of the European names that are now looking very cheap relative to history.
You know, Eddie, we've seen the beginning of earnings season here, kind of a mixed bag, some good news, some bad news. Everyone I've talked to is sort of bracing for a nasty revision to estimates in this quarter for the rest of the year and 2023. How are you thinking about that? Is that priced in already for the most part, or is there more sort of pain to come in the market because of it?
I think it's the most over-discussed topic in the market, actually. I think if I had $1 for every strategist I've heard say, hey, 240 on the S&P's 2023 number is not right, the real number is 200. If I had $1 for every time I heard that, I'd probably have $200. Everyone knows the number is 200, or maybe it's 190 or 210, but we all know earnings have to be cut. Anyone who hasn't been paying attention, and the market's forward-looking. So some of that, maybe all of that, is already in the price. And I think you have to look through that and ask yourself, what is the underlying earnings power beyond 2023 of these companies? If 2023 is a recession year, then you don't want to be putting a PE multiple on that number because that's a trough number. So what is the normalized through-the-cycle earnings power of these companies? Has it been permanently impaired by COVID or geopolitics or anything else that's going on in the world? I think the answer is no, for the most part, in most cases. And therefore, you should be capitalizing a number higher than 200 for the S&P and putting, whatever you want, 18, 20 times on that, and you're into a price target for the S&P that starts with a 4.
Yeah, does that mean we eventually revert back to that sort of pre-COVID leadership with tech and growth and that sort of thing being the real drivers of the indexes higher?
I think that's a good question. My answer is it's rare when you get a big market sell-off that coming out of that you have the same leadership as you had before. So, technology companies, growth tech they're great companies. They were very rich coming into this, and I think we probably have had a regime change where it's now going to be more about value stocks. That means financial stocks, particularly the banks. It means commodity stocks like energy, which has performed very well this year and yet is still under-owned by most investors. And it means finally investing overseas. Europe and Japan, international stocks to me look more compelling on a valuation basis. Granted, the economic news is pretty ugly.
Right. One thing I'm curious, Eddie, I mean, you guys, the Eaton Vance portfolio, there's a lot of choices for investors out there, fixed income side, equity side. Where is the money flowing right now, in and out?
I think you see a lot of investors want to avoid anything that's credit sensitive. So, I think the bank loan category, so mutual funds that invest in bank loans are seeing outflows across the industry. And I think most active equity funds are seeing outflows as well. We run Calvert funds, so Calvert branded ESG funds, and we're seeing good inflows in a number of those Calvert equity strategies.
Well, Eddie, is it a fool's errand to try to time this market right now? Quickly, I think we got about a minute
come
left.
on, Mike, you know the answer to that.
I know. I'm setting him up. I'm throwing him a softball, Carol.
I think it's always a fool's errand to try and time the market. I think that's what everyone's trying to do. You have a lot of people who recognize that sentiment is very negative, cash levels are very high, and so you have a lot of people saying, hey, early 2023, the market's going to rip. The problem is if you wait for the perfect moment, you might miss it, and so the best advice is the simplest: stay diversified, dollar cost average your way in, relieve yourself of the psychological imperative to time the market perfectly, and just make sure you're there at the bottom when it comes, and you do that by dollar cost averaging.
Or leave it in cash for a little bit longer until you really get some clarity on what's going on. Dare I say. Eddie, thank you so much. Eddie Perkin, Chief Equity Investment Officer for Equity at Eaton Vance, joining us on the phone from Boston. But I do wonder, though, like at a moment where there is still so many questions. I know you can't time it, but you can certainly do, preserve some, what's in your portfolio.
Well, yeah, and your point about cash, I mean, it's finally has a real yield on it,
right?
Not a real yield above inflation, but a noticeable yield that doesn't round down to 0%. So it makes that decision a little tougher to try to take on risk. Exactly.
All right, folks, just about 2.5 minutes left in today's trading session. We've got equities just rounding off the bottom, but we're down across the board. It is time, though, to head over to our TV colleagues for Beyond the Bell, our cross-platform coverage live on Bloomberg Radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we are about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, counting you down to the closing bell. Here to help us take us beyond the bell. It's a global simulcast. It is Carol Masser, it is Mike Regan, who is in for Tim Stenovic. And we want to go across our audiences of TV, radio, and YouTube to dissect what is a day of yields pushing higher, of volatility across the pond, and of volatility in the equity markets.
I want to push Beyond the Bell to Saturday. I don't know about you guys, because it has been a dense day, dense week again. Really broad-based for the most part in terms of selling. And I'm going to go back to what I talked about earlier. Semiconductors continuing to outperform, certainly seeing it in Lam Research, and you're seeing it in the SOX still holding on to a slight gain, well off its highs though, but Mike, still up about 0.8%.
Yeah, Carol, and I've got one number in mind right now, and that is the number 5%. The Fed funds futures are finally fully pricing in a terminal rate of 5%, even a little bit higher. And not only that, Taylor, they're also not really pricing in much of a cut for next year. So markets right now pricing a 5% interest rate on Fed fund futures starting in March and pretty much staying there for most of the year, Taylor.
Mike, what does the 3666 on the S&P mean to you as well when we think about the significance of these numbers? That was the big June lows. We seem to retest that a few times, dip below it. Now we're right back there.
Yeah, right. And we just had Abigail Doolittle, our colleague, on saying, do not expect that low earlier this month to hold. She's expecting even lower lows, Taylor.
Lower lows. At the moment, we are below that 366 number. As we hear the closing bells, we're off by 0.8%. We just dip into that closing bell. 8 seconds until trade halts, and we're at 3,665. That's where we trade on the S&P 500. 31 points, let's call it 30 points to the downside. That is 0.8% lower. Bloomingdale's ringing that bell over at the moment, and we're seeing, though, still no love for any of the benchmarks. The Nasdaq's off by 0.6%. We see the Dow Jones Industrial Average off by 0.3%, just 91 points lower. And then we have a look at the Russell 2000, which has been an underperformer throughout the day of trade, off by more than 1.2%.
Yeah, and interesting, Caroline, with the day with, again, another bout of volatility. Maybe we understand why it happened, but nonetheless, some swings here. The VIX moving down, Taylor, just a little bit, down about 0.5 point, staying at about 30.
Take a look at where we are on the sector level, Carol, because you have a few names in the green, but it's really not much home to write home about when you think about the breadth of the sell-off. Telecoms are the big outperformer today. You're up 3%. Otherwise, it's semiconductor, software, and energy. Wow, am I a broken record or what? Energy is still one of the top performers here, but you're only up about 1 to 0.2%. Everything else is in the red, Carol, and this is sort of the significance. Even though we're not getting a 2 to 3% sell-off, you're getting some decent number sectors that are still in the red. I'll bring you down to the bottom. Some of this does feel like that inflation story with household products, utilities, transportation. We've talked a lot about the weak numbers from Union Pacific as we wait CSX, and then those key auto components as well. You're off about 5.7%. I'm looking at you, Tesla.
Tesla, right? Down, what, 6.7%, so a pretty significant decline there. All right, let's get to some of the gainers. Actually, some real big outperformers despite so many names lower in today's session, and that includes Lam Research, up more than 11% at its highs today, finishing the day with a 7.8% gain, top in the S&P 500, NASDAQ. We talked about the earnings briefly last night. A capital equipment company, the first quarter results that did beat, and it also gave an outlook that analysts said should result in a more realistic consensus expectations, reducing some downside risk. So there was some upgrades from the analyst community. Others cut their price target, but that reset about maybe what our expectations should be for the semi sector, analysts really liking what they heard. IBM outperformance up 4.7%, sales topping estimates, affirming its cash flow forecast. Our Anurag Rana saying that was an important thing and a sign that demand for software, mainframe computers, and hybrid cloud services remained steady. So there was a strong turn in today's trade. AT&T, one of the old guard, if you will, when it comes to the equity universe, up almost 8% in today's session, top of the S&P 500, biggest gain since the early days of the pandemic after reporting better than expected profit and customer growth. It was up, you guys, up more than 10% at its highs today. Mike.
Yeah, Carol, let me get back to Tesla. Bad day for Tesla, obviously down 6.7%. Boy, third quarter sales still rose 56% to 21.5 billion, but that wasn't good enough for analysts. They expected 22.1. Elon Musk acknowledging that the downturn in China and Europe and the Federal Reserve's interest rates increases, all the things we've been talking about are having an effect, saying demand's a little harder than it would be otherwise. The other big dramatic move today, Allstate shares down 13%. That's the most since 2020. Insurer basically saying that it expects a third quarter net loss of as much as $725 million. Hurricane Ian claims from that is one issue, but really inflation is that nasty word popping up again, even for an insurance company. Piper Sandler analysts saying they just struggled in recent quarters to get ahead of accelerating claims inflation. And finally, Union Pacific Corp fell 6.8%. Another sort of macro warning here from this company. They cut their forecast for volume growth to reflect a, quote, challenging year, adding the concerns about inflation and bloated inventories. They expect carload volumes to increase roughly 3% this year, down from an earlier forecast of as much as 5%.
Meanwhile, we look across the board of global macro movers. I look at an FX space that is once again a story of dollar strength on the day. This as we see the Federal Reserve members, this time perhaps coming from Elisa Cook on one side. You also get utterings coming from the Fed governor over in Philadelphia, Harker, talking about where the terminal rate will have to go for this year and maybe continue to go higher at least a 4% by the end of this year. We see dollar strength. That means weakness, Swedish krona, Norwegian krona, Japanese yen busting through that 150 level. Of course, all important as to what the BOJ and indeed other authoritative figures over in Japan do to try and, well, get some sort of strength within their currency that, of course, they're somewhat worried about the amount of weakness. I'm looking at commodities that, of course, have been topsy-turvy. We did have some hopes, some utterances, some rumors that maybe China would be looking towards alleviating some of those quarantine periods. That did well for the likes of oil that pushed a little bit higher and sustained a little bit of the day. It was up as much as 3%. We dialed back from that. Metals got a lift, perhaps. Iron ore is up 1.5%. We're also seeing the natural gas falling back lower for no more than 2%. Again, and finally, some production alleviating some of the concerns. We do see the pricing pressure on nat gas come off here in the US. Sovereign bonds, a mixed picture. You have money sort of in the UK. We saw some stability in the gilt yields at least, but over in Japan, we saw yields push higher, for example, and indeed in Canada, they were up some 12 basis points.
Huge story that is the same, Caroline, within full faith and credit. I think it is fascinating that earlier, just a few days ago, we were looking to see if a 30-year could hold on to that 4% level, and we've really started to drift upwards. A 4.60 on the 2-year, a 4.25 on the 10-year, and almost 4.23% on a 30-year. So you're really well above 4%. I think it's interesting. We're also getting some interesting earnings as well. Carol, I know that you're looking at a few. I'll just quickly hit CSX as well. A better top margin bottom line, $3.9 billion for third quarter revenue ahead of estimates, better operating income, and a better bottom line, 52 cents a share relative to estimates of 49. And they're coming out and saying that they still are targeting full year double-digit revenue operating income growth. a good improvement here for that company.
You know, one stock too that was definitely a pandemic play, Whirlpool, right? Really, when everybody was living at home, they were buying lots of appliances. Well, it's a different tone, certainly, in this latest earnings report. Stock down almost 6% here in the after hours, and it has to do largely too with the outlook. Seeing fiscal year ongoing EPS, we're talking about $19. It had seen 22 to 24. The estimate on the street was 21.85. So cutting that year ongoing EPS view. You know, Caroline, I think about, right, this was something that just couldn't keep up with really demand during the pandemic. This stock, by the way, did hit a 52-week low in the regular session and says elevated inflation resulted in slowing demand. Whirlpool saying it sees challenges persisting into the first half of 2023. So again, here's something when it comes to outlook. It says a strategic review when it comes to some of the emerging markets and other markets nearing a conclusion.
Yeah, in EMEA, so that's Europe, Middle East, and Africa. It's interesting that they talk about this challenge of 2023. That seems to be the narrative coming from some CEOs. It's fine for the time being, but next year is when the headwinds are really going to hit from a demand perspective. Adidas over in Germany talking about, of course, a dialing back in demand overall. And as you say, this is such a pandemic darling as everyone was so desperate to get their hands on new goods, but notably the housing rollover, the fact that we are seeing concerns coming to the cracks forming in the US housing and real estate sector, and indeed worldwide as rates push higher, that's got to be an overall headwind on this company.
Yeah, and also I'd point out Tenet Healthcare out with guidance saying they see fiscal year adjusted EBITDA of $3.38 billion to $3.48 billion, a little bit of a tighter range than the $3.38 to $3.58 billion that they saw, but boy, the stock is not taking it well, down about almost 9% in post-market trading there, Carol.
All right, so certainly some names to follow into the Friday trade. As you said, Tenet down about 8%. All right, folks, that's a wrap. A lot going on. Wrapping up some of the earnings after the close. We will be back. Our cross-platform coverage, radio, TV, YouTube, Beyond the Bell. We will catch you again, same time, same place tomorrow.
This is Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, everybody. Our thanks to our TV colleagues. Just following those earnings names in the after, Mike, you were breaking down Tenet. It continues to be down about 6% here in the aftermarket. So we are seeing some selling. I'm thinking about, we talked about healthcare earlier. This has often been, I think our market guest actually said, if you're going to look for kind of a defensive play, healthcare, he liked it, but
yeah, not so much this time. But, you know, really, it just goes to show you a lot of surprises in this earnings season. You know, there are positive surprises, negative surprises, but we're seeing some really dramatic moves because I don't think anyone really had too much confidence in what any company was going to really meet or miss their estimates.
Yeah, and we know the bar was brought down low. And I do think those pandemic plays continuing to do a reset. Whirlpool off its lows in the aftermarket, but still down about 1%. All right, let's get back to world and national news. Over to Nancy Lyons in D.C. Hey, Nance.
Thanks, Carol. President Biden is vowing to continue close cooperation with Britain following the resignation today of Liz Truss as prime minister. She stepped down after a 6-week premiership that was marred by political and economic chaos.
Given the situation, I cannot deliver the mandate on which I was elected by the Conservative Party. I have therefore spoken to His Majesty the King to notify him that I am resigning as leader of the Conservative Party.
Truss says a new party leader and prime minister will be chosen next week. She'll go down in history as Britain's shortest-serving prime minister. The U.S. says not only have Iranian drones been used by Russia to attack Ukraine in recent days, but Iranian operatives have had boots on the ground in the region. State Department spokesman Ned Price.
We assess that Iranian military personnel were on the ground in Crimea and assisted Russia in these operations.
The State Department's Ned Price. Officials say the Biden administration is looking at imposing new sanctions on Tehran and making it harder for it to sell such weapons to Russia. President Biden is in Pennsylvania today, where earlier he visited a Pittsburgh bridge that collapsed earlier this year. It's been repaired and updated as a result of the bipartisan infrastructure law.
Pennsylvania's been able to repair Fern Hollow Bridge in less than a year, and by Christmas, God willing, we'll be walking I'm coming back to walk over the sucker.
Biden is also stumping for Lieutenant Governor John Fetterman in Philadelphia. He's in a tight Senate race with Dr. Mehmet Oz. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Masser, along with Mike Regan here in our Interactive Brokers studio. We are watching shares of Snap dive in the after hours. Right now down more than 16%, 17%. So a big drop off. This after the company third quarter revenue, $1.13 billion. The estimate was $1.14 billion, so a slight miss there. But also catching our attention, not providing formal financial guidance for the fourth quarter. The company did authorize a stock buyback of up to $500 million. Third quarter daily active users, 363 million. That's better than the estimate of 358.7 million. And if we look at the adjusted EPS, 8 cents a share. The estimate was for a loss of 2.2 cents a share. But Mike, this stock is selling off.
Yeah, it just shows you any sort of crack in the numbers that don't meet estimates, and you're going to get punished in this. I was impressed by the rest of the world revenue, 155.5 million, up 22% year over year. So they're finding growth outside of the U.S. and Europe, but clearly not enough to sort of counteract that huge North American audience revenue there, 811 million, as you pointed out. But there is some growth there, so there is an interesting story to be told. But boy, the market's not liking it at all.
Free cash flow, 18 million compared with 52 million in the prior year. Just looking at the press release, they say, Evan Spiegel, the CEO, this quarter we took action to further focus our business on 3 strategic priorities: growing our community and deepening their engagement with our products, re-accelerating and diversifying our revenue growth, and investing in augmented reality. So we'll look for some more color. We're going to actually talk with our Alex Barinka in just a moment to get a little bit of insight into that. In the meantime, we're going to talk a little bit about women when it comes to investing and the importance of it. We're going to talk about gender or being gender smart when it comes to investing. So we're going to get to that in just a moment with Suzanne Beagle. She's co-founder of a company called Gender Smart, and she's going to join us in just a moment. You are listening and watching Bloomberg Business Week. I'm Carol Masser along with Mike Regan, and this is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Lots of earnings after the close of trading. Snap Inc. shares plunging now by 22%. Snap reported its slowest quarterly sales growth ever, saying that a decline in ad spending on the platform continues to drag on results. The social media company spent the quarter shrinking and refocusing its business, announcing in August that it was cutting 20% of its workforce and slashing projects that don't contribute to user or revenue growth. Also reporting earnings after the close of trading, Whirlpool, it reported lower than expected sales and earnings for the third quarter. It cut its outlook for the year, citing softening demand and rising inflation into 2023. After hours, we've got Whirlpool down now by 3.5%. Briefly, Tenet Healthcare reported adjusted EPS from continuing operations for the third quarter that missed estimates. Tenet after hours down by roughly 5%. It was another down day for stocks. The Dow, the S&P, NASDAQ, all in retreat. Treasury yields climbed amid hawkish remarks from Federal Reserve officials. The S&P 500 index did end the day down by 29 points, dropping 0.8%. The Dow down 90, a drop there of 0.3%. NASDAQ Composite Index down 65 points today, a drop there of 0.6%. 10-year 4.23% right now. The 2-year 4.61%. Spot gold down 0.1%, $16.27 the ounce, while West Texas Intermediate crude oil was up 0.5%, $85.98 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
And just to reiterate, Snap's still down about 21%, reporting its slowest quarterly sales growth ever, saying that a decline in ad spending on the platform continues to drag on results. Speaking of drag, it's dragging Meta down about 5% in the aftermarket, and Pinterest is right now down about 9% as well in sympathy. All right, our next guest, Websites, notes that they coined the term gender smart and is now focusing on the integration of gender analysis into a newer existing investment process for better social and financial outcomes. Suzanne Beagle is co-founder of Gender Smart. It's a community of individuals across the finance ecosystem, and they're working on moving more gender smart capital more strategically around the globe. So let's get more on her efforts and outcomes. She joins us via Zoom from the UK. Hey, Suzanne, nice to have you here with Mike Regan and myself. I want to start, if I can, with some of the news, because you are in the UK. And of course, we've been focusing on UK Prime Minister Liz Truss resigning. Women in leadership roles, how does a development like this impact the narrative around women leaders, or how we think about being gender smart, if at all?
Well, I think the reality is that for women or male leaders, the key is to be paying attention to what people really need. Healthcare, access to affordable energy, access to goods and services that make their lives better, and that gender balanced leadership and leadership that's really paying attention to the stakeholders that are involved is what we need. So I don't think that Liz Truss's particular position says anything about gender lens investing.
Well, Suzanne, if I'm an investor, how do I approach this issue? Is it a matter of sort of counting up the number of women on boards and in management positions? Is there more to it? How do I invest with a gender lens?
Thanks for asking that. So the first is that we're really thinking about where we see women in leadership, governance, employment, supply chains, and customers. And the key is to really be thinking about not only counting, so where do I see a woman on a board or where do I see a woman entrepreneur, but really looking at, is that entrepreneur creating something of value in the market? Do they really have product market fit? Do they understand how to really value their labor and their supply chains? And are they creating good policies and practices? And it could be male or female-led businesses, but where do you see gender balance and where do you see attentiveness to what the needs are of those different kinds of stakeholders? So in a bigger company, in a listed company, you might be thinking about the policies and practices. Do they have good care benefits? Do they have good leave benefits? Do they have pay equity? What does it look like from a recruitment, retention, advancement, promotion perspective? And what we see and what the market sees is that where you have better gender, attention to gender, and those gender balanced practices, you get better financial outcomes and you get more access to talent, you get access to customers, you get access to innovation on a different level.
So as with some documents you share with us, and we talk about this a lot, that, diversity, including women, and just in general having, a more diverse senior management, diverse boards, it does lead to a better financial outcome. What are some of the numbers that you are finding and some of the work that you're doing with investors or the investment community? What are some of the outcomes that you're getting?
So I look at Bloomberg New Energy Finance came out with a report at the end of 2020, looking at where you have, publicly listed companies with better gender diverse leadership and governance, better climate outcomes, better innovation outcomes, and better financial outcomes. And so I think about anyone who is looking in the 21st century at who is a climate smart business, and who is really going to be paying attention to the trends and the indicators that we need there, is going to be looking for gender balance and diversity, equity, and inclusion as part of the solution.
And if you're
go ahead.
Oh, I'm sorry, Susan. If you're an investor, sort of assessing the entire investment landscape, is there a solution to do this efficiently? Sort of a technological way to sort of score gender equality the way you would some of the ESG factors?
Yeah. So there's a company called Equileap. Equileap, MSCI, and a number of others are doing this work. And if I think about Equileap, which I think is the top on this level, they're looking at 19 variables. So they're looking at, again, where do you have not only women on boards, but what roles are they in? They're looking at women in leadership. Again, what roles are they in? And what's going on with pay equity, including, by the way, bonus compensation, which is an issue that people often will leave out when they're talking about pay equity. When you're looking at employment, again, those different factors around the policies and practices. Similarly with supply chains, do you have a resilient supply chain where pay is fair, where working conditions are fair? And in some places, obviously, there's legislation and mandates around that. Here in the UK, Modern Slavery Act, and in other places, we don't have that requirement for data collection. From a customer standpoint, you'd be looking at, again, where do you have customers who are, where do women customers really value those products and services and improve their life? So they look at these 19 variables, they compare across 4,000 companies, and they are their data is feeding about $1.5 billion in funds
Suzanne,
right now.
We have to run, but hopefully we can catch up with you again in the near future. Suzanne Beagle, co-founder of Gender Smart, joining us via Zoom from the UK. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week, and this story is among our most read on the Bloomberg terminal. It's also the Bloomberg Big Take. Mike, we're going to talk about small gun makers in just a moment.
Yeah, there's really a million of them these days, I guess. They really sprouted up. Building these AR-15 sort of knockoffs is kind of a scary time.
Yeah, and figuring out how to do it without catching the glare of regulators, I should say. All right, we'll get to that in just a moment. First up, though, back to Charlie Pellet and all that news after the close.
Indeed,
Hey, Charlie.
lots going on, all about earnings. And look at Snap shares plunging now by 24%. Snap Inc. reporting its slowest quarterly sales growth ever, saying that a decline in ad spending on the platform continues to drag on results. Again, worth repeating, Snap now plunging by 24.5%. Social media companies spent the quarter shrinking and refocusing its business, announcing in August that it was cutting 20% of its workforce. Whirlpool is reporting lower than expected sales and earnings for the third quarter, and it cut its outlook for the year, citing softening demand and rising inflation into 2023. The 111-year-old appliance manufacturer sells all manner of appliances ranging from refrigerators to stand mixers. So with all of the earnings, what about the overall outlook? Eddie Perkin is Chief Investment Officer for Equity at Eaton Vance, and he was our guest right here on Bloomberg Business Week.
We all know earnings have to be cut. Anyone who hasn't been paying attention, and the market's forward-looking. So some of that, maybe all of that, is already in the price. And I think you have to look through that and ask yourself, what is the underlying earnings power beyond 2023 of these companies? If 2023 is a recession year, then you don't want to be putting a PE multiple on that number because that's a trough number.
And today it was a down day, stocks wiping out a 1% advance, S&P ending lower by 29 points, down 0.8%. Treasury yields climbing amid Fed speak. We have the 10-year now at 4.23%, 2-year yield 4.61%. Again, the S&P down 0.8%, the Dow dropped 0.3%, down 90 points, NASDAQ down 61. Spot gold down 0.1%, 16.27 the ounce. West Texas Intermediate crude up 0.5%, 85.98 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get to a startling story that's on the Bloomberg terminal. It is the Bloomberg Big Take. It is also among the most read. It is about the small gun makers finding state weapons bans are offering up a lucrative niche. What exactly are we talking about? Well, let's go to our Chicago bureau on the phone there. Jason Grotto, he's Bloomberg News senior investigative reporter, joining me and Mike Regan here. Hey, Jason. So tell us about what's going on.
Well, so, what we found is that over the past 9 years or so, a real explosion in the number of gun manufacturers in the U.S., licensed gun manufacturers. It's doubled now to more than 18,000. And they're pretty much in every state of the country, operating out of strip malls, warehouses, even some folks making guns in their garage. It's really been driven by a few things. One is the changing technology, the low barrier to entry now with machine technology that allows folks to easily make guns. That's number one. Number two, the regulations surrounding gun manufacturers create a pretty low bar. You don't have to have any experience. The fee's only $150. And as long as you have a place to do it, they'll give you a license to start making guns.
Yeah, and Jason, somehow they're designing these guns to get around what restrictions are in place for, say, an AR-15. How exactly are they doing that?
Yeah, so there's about a dozen states around the country that have some type of restriction on firearms. And what that's really done, ironically, is it's created these niche markets for some of the smaller gun makers. The big guys like Smith & Wesson and Colt, they're not going to retool their operations to be able to sell certain kinds of weapons in New York or Massachusetts or Connecticut. So gun makers there have used the really intricate technology of gun manufacturing to find ways around efforts in those states to restrict the type of weapons that folks can buy. So, for example, the AR-15, which is a very controversial firearm. Some folks call it an assault rifle. Others call it a modern sporting rifle, depending on which side of the fence you stand. Well, so the state of New York in 2013, after the horrific Sandy Hook elementary school mass shooting, passed legislation that tried to limit the type of firearms that folks could buy. And one of the things they said is, you can't have an AR-15 type weapon where you could have a detachable magazine. So a company that we profile in our story, Dark Storm Industries, patented an AR-15 style design where there's a small screw that fixes the magazine in the firearm and only holds 10 rounds to get around that law or to comply with that law, again, depending on which side of the fence you sit on. The lawmakers who wrote the law, some of them are upset and are now trying to find ways to close some of these so-called loopholes.
Yeah, I wonder, do they stand a chance, in this political climate, do they stand a chance of being able to close these loopholes, do you think? I'm sure it's a state-by-state basis, but it seems like a tricky thing to do given the political environment today.
Yeah, I think that's right. I mean, and that's why we have sort of a piecemeal or patchwork regulatory system right now where state by state the laws are very different. The other issue is just the complexity of gun making or gun manufacturing. There are so many nuances that go into making a gun, and a lot of these laws, some would say they're too specific about what constitutes an assault weapon, let's say. And so advocates who are looking to place more restriction on guns in the U.S. are saying the laws need to be broader. We need to not get into the weeds with this so that, the gun makers who are very nimble and smart can find ways around it.
I wonder, is obviously the prices of these would be some sort of a barrier to how much they flourish around the country. How much are they selling some of these guns for, these sort of niche, smaller manufacturers?
And Jason, just got about 30 seconds left.
Yeah, sure. That's a really great question. So one of the things driving this is the fact that the AR-15 is component-based. So you can really buy components that make up the AR-15, and the basic component, the receiver, can go for as little as $80.
Wow.
And then you just buy the stuff from there.
It's nuts. There's a quote in your story. And first of all, I recommend everybody to go to Bloomberg.com because it's interactive and it's really, really impressive and powerful to read online. But there's a quote by a former ATF agent. We've just got to a point where the average Joe, like building Legos or a kit, can build their own guns. Jason Grotto, great reporting. It's the Bloomberg Big Take. Jason is senior investigative reporter at Bloomberg News, joining us on the phone from our Chicago bureau. But again, you can find this story. It's the most read on the Bloomberg terminal, and also check it out at Bloomberg.com. All right, let's head back to World and National News and to Nancy Lyons over in D.C. Hey, Nance.
Thanks, Carol. President Biden is in Pennsylvania today promoting the bipartisan infrastructure law that has helped repair a Pittsburgh bridge that collapsed earlier this year.
Pittsburgh's a city of bridges, but too many of them are in poor condition, like this bridge behind me before it collapsed. With the bipartisan infrastructure law, we're doing something about it. This is just one of 2,400 bridges across the country that are being repaired just this year because of this law.
From Pittsburgh, Biden traveled to Philadelphia, where he will stump for John Fetterman, who is in a tight Senate race with Dr. Mehmet Oz. Florida is still working on recovering from the damage from Hurricane Ian, and today Governor Ron DeSantis announced a special session of the Florida legislature will be held to consider providing property tax relief for people and businesses whose property was destroyed. DeSantis is also extending the deadline for those residents to pay their property taxes. More political upheaval in the UK today, with British Prime Minister Liz Truss resigning 45 days after taking office. She served a tumultuous term in which her policies triggered turmoil in financial markets and a rebellion in her party. Sir Jake Berry is chairman of the Conservative Party and outlines next steps.
In conjunction with the 1922 committee, we have decided that if the party should decide to put forward two candidates, there will be an expedited, binding online vote of Conservative Party members to choose its next leader. All stages of the leadership election will be concluded by no later than Friday, the 28th of October.
Barry says nominations will close Monday. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. So we want to just get back to Snap for a moment. I know Charlie's been all over it. Snap shares in the after hours down 25% this, Mike, after reporting its slowest quarterly sales growth ever. Company coming out saying that a decline in ad spending on the platform continues to drag on results. Pinterest is down more than 7% in the after hours following that drop in Snap, and we're seeing Meta shares down about 4% in the after hour market.
These stocks tend to move in a flock,
right?
Of course, the social media stocks. But here's what is kind of surprising to me, Carol, is they still managed to add 57 million daily active users in the quarter for a total of 363 million. And look, as the father of 3 daughters, I know they're still using this app. This is still a very
It's not
popular.
like nobody's using it, right?
Right. It's just some issue with monetizing it. I guess there's so much competition with TikTok and whatnot. And I know we have a guest coming up who will help us sort it out.
Yeah, the company spent the quarter shrinking and refocusing its business. Remember, back in August, it said it was cutting 20% of its workforce and slashing projects that don't contribute to user or revenue growth or to the company's augmented reality efforts. Changes were in response to plunging sales, which Snap attributed to a slowdown in marketer spending. I mean, that is fair. We've talked about it, right? There's so many social platforms. They're all competing for these ad dollars, and the big guys seem to, weather it in general, but it's some of the smaller players, relatively speaking, it's a little bit tougher.
Yeah, right. And just with such an uncertain outlook, it's safe to assume a lot of companies are probably cutting back on that ad spending. So it's a bunch of apps fighting over a shrinking pool of advertisers.
Yeah, Snap saying in its prepared remarks for investors, quote, "We are finding that our advertising partners across many industries are decreasing their marketing budgets, especially in the face of operating environment headwinds, inflation-driven cost pressures, and rising costs of capital." I mean, it's the stuff we talk about all the time,
It's
right?
It's all coming home to roost.
It's not easy. We heard it from the head of New Balance earlier. It's not an easy environment right now. It's tough, and there's stuff coming at us from all angles. All right, we're going to talk a little bit more about this with our Alex Barinka. We're going to talk about that plunge in Snap in just a moment.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Snap plunges after hours, and companies that rely on digital advertising are tumbling in post-market trading after Snap Inc. reported its slowest quarterly sales growth on record. Snap down now by 25%. Pinterest, though, leading declines with a slump of as much as 9.4%. Meta Platforms falling 5.2%. And again, we did have Snap down now by about 25%. It was a down day on Wall Street. Stocks managed to wipe out a 1% rally with Fed speak boosting yields. Today we had the S&P down 29, a drop there of 0.8%. The Dow was down 90, a decline of 0.3%. NASDAQ lower by 65 points today for the NASDAQ Composite Index. That is a drop of 0.6%. The 10-year yield, 4.23%. The 2-year yield, 4.61%. Spot gold down $1.40 the ounce to $16.28, lower by 0.1%. And West Texas Intermediate crude up 0.5%, $85.98 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We've been talking about it a lot. Shares of Snap just plummeting in the after hours. We've seen a drop of as much as 25%, but really under a lot of pressure. Trying to make some sense of it, we did report that the company reporting its lowest quarterly sales growth ever, saying that a decline in ad spending on the platform continues to drag on results. But Mike keeps pointing out, right, people are using it.
Yeah, right. Added 57 million daily active users in the quarter for a total of 363 million. That's the type of stat alone that used to really pop the shares of a company like this, but it's, all about how are you monetizing it now and if you're actually able to monetize it.
All right, so let's see what Alex Borinka has to say. She's Bloomberg News technology reporter. She covers the company. She is on the phone from LA with that and some more as we get ready for a deluge of big tech to report earnings. All right, Alex, what do you make of this report?
I think Mike was spot on there. The user growth here actually does look strong to his point, but the big question for Snap has been how much of this pie, this big pie of money that advertisers spend on social media platforms and internet platforms, how much does Snap get? And we've seen over the last few quarters that they've really struggled in a time where marketers are frankly spending less to advertise online. The CEO, Evan Spiegel, has pointed to things like macroeconomic uncertainty. They've pointed to things like the changes Apple made to its privacy policy, which make it harder to track the efficacy of ads. But when you look at Snap itself, this is a platform that their ad products have mostly been what we call upper funnel. They're things that tell you a story about a brand. They're less about converting to purchases. And that has been kind of a tricky wicket for them, and that tricky wicket has apparently continued into this third quarter.
Yeah, Alex, I wonder, as a father of 3 teenage girls, I got to say, my daughters are being monetized left and right by social media in every possible way. But is that part of it? Are Snap's users, I'm assuming they skew younger and it's harder to convert to sales from that age group? And you've also have, you speak of that share of the pie. TikTok certainly is taking a bite of that pie as well. So are those valid challenges for Snap at this point?
Yeah, I think they are. And to your point, Snap's kind of been known as the owner of the youth, right, online. And TikTok is kind of pushing in on that. So if you put yourself in a marketer's shoes and, you have really reliable ads on Google and Meta's platforms like Facebook and Instagram, and you're looking to experiment somewhere with a younger demographic, you might have in the past gone to Snap. Well, TikTok is kind of pushing in for that ownership of the younger generations, and that's proved a bit of a challenge that I think will continue as they fight for these ad dollars.
What else are you expecting this week? It's really getting into the heavy season of tech earnings. What else are you watching this week?
Yeah, so we'll start with social media. So Snap is kind of a bellwether for kind of the health of all of these ad-dependent internet platforms. Not so much this week, but next Tuesday, Meta will report its earnings, the owner of Facebook, and we will be paying attention to kind of what Meta has to say in terms of ad growth. The other companies reporting next week are the 2 mega retailers, Apple and Amazon. Look, it's been an interesting year with a lot of questions around what is inflation's impact on consumer spending. And these two tech giants will kind of give us a little clue into how were they spending on things like Apple iPhone 14s over the past quarter, and how do we think they will spend in terms of holiday shopping on platforms like Amazon. So those are the big things on my mind with this kind of Snap report being the first early clue into the social media world.
If we could go back a little bit to Meta, because Alex, obviously this pivot from social media to the metaverse has not exactly been warmly received by investors, if I say it politely.
You're being kind.
What are any idea? I'm assuming it's still too early to kind of start gaining significant revenue from the metaverse. What do you think the focus will be there on that earnings call and in the statement regarding that balance between social media, your Instagram and your Facebook, and this big experiment in the metaverse?
Yeah, and the experiment is quite large for Meta. So they're spending about $10 billion a year on development for the metaverse. That equates to almost 10% of what we expect them to make in revenue this year. So it's an experiment, but it's a really big one. So we'll definitely be paying attention to that. As you said, we don't necessarily expect a lot of monetary numbers around the metaverse because it is still early days. But for Meta, they still have their Instagram, Facebook, and WhatsApp platforms, which are kind of going to be the funders, right, of these aspirations to create this next generation of the internet and the metaverse. So similarly to what we're looking at with Snap, with Meta, we'll be looking at Instagram and Facebook and seeing are advertisers spending more money there. They have continued chasing TikTok themselves, pushing into new content formats like short form video. And in the past couple quarters, they've really started adding new ad formats to that type of content, which again, for investors around earnings season, it's really important to see how those are faring. So it'll continue to be this balance. And I think the more that Facebook and Instagram continue to perform, perhaps the more patience investors might have with Meta. But Mike and Carol, if you look at Meta's shares this year, they're down to.
I'd rather not look at that stock chart.
They might not rather either, but it seems like there might be some questions around what level of patience investors might have as they continue to push in new areas while hoping that the old areas continue to perform.
Yeah, great story by Max Chafkin from Bloomberg Businessweek about how basically Mark Zuckerberg is just all in on the metaverse and not really paying much attention to the company, the part of the business that still is so important to Meta. And we're talking about what used to be the name brand Facebook, that he's just much more consumed with the metaverse. Shares of Meta, by the way, down about 60% so far this year. Alex, we have to run. Really great stuff. Looking forward to your coverage. Alex Barinka, Bloomberg News technology reporter, joining us on the phone from LA. And as we get ready to wrap up, shares of Snap, though, Mike, you bring up some good points. People still using it, but nonetheless, some disappointment over Snap. Shares are plunging in the after hours. They're down 25%. We're talking about a quarter haircut right there.
25%, and a stock that was already really beaten up this year. But it's kind of dumb luck in a way when you have to report earnings on a very negative day in the market, a very risk-off day. You tend to get perhaps an exaggerated move. This seesaw has been going all over the place in the stock market. So it'll be interesting to see if we get that bounce back tomorrow and how much they recoup.
Yeah, that's a really good point. Meta, by the way, was also down. Pinterest is down almost 8% in the after hours. And if I take a quick look at Meta platforms here in the aftermarket, it's down about 4.6%, and Alphabet's down about 2.6%. So
ugly day in the metaverse, I suppose.
We'll see whether people come in to buy ahead of the weekend tomorrow. All right, Mike Regan, thank you so much.
Oh, anytime. Thank you, Carol.
Yeah, I love having you here, and I love your market perspective. We really appreciate it. Mike Regan of our Bloomberg News team covers the markets for the Business Week team. I'm Carol Masser. Have a great and safe evening. This is Bloomberg Radio.